Good morning from London. I'm Anna Edwards alongside Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. Bloomberg sources say senior US officials are preparing for a possible strike on Iran in the coming days. President Trump says he's keeping his options open. The Fed leaves interest rates unchanged but warns that some of the impact of tariffs will fall on the US consumer. And today, the Bank of England is expected to hold interest rates, while the SNB could cut them to zero. We'll bring you the Swiss decision later in the show.
Well, and I'll pick up on that theme because, of course, this is my personal obsession this morning, keeping an eye on that risk haven, especially when it's under kind of consideration against the other risk haven, which, of course, is dollar Swissy. We are seeing strength in favor of the dollar this morning, weakness on the expectation that the SNB is likely to cut. Brent crude as well, one eye on the Middle East, trading higher this morning. Marginally, trading at a 76 handle. But you can see there is nervousness in this market, despite the fact that the U.S. is closed today. We don't have a read on the bond market either. Euro Stock 50 futures down a whopping 0.7%. The countdown to the opening trade starts right now.
Iran's got a lot of trouble. And they want to negotiate. And I said, why didn't you negotiate with me before? All this death and destruction. Why didn't you negotiate? I said to the people, why didn't you negotiate with me 2 weeks ago? You could have done fine. You would have had a country.
President Trump there reflecting on his intentions, keeping everybody guessing really around his intentions when it comes to Iran. So let's start our conversation there, Kriti, this morning. On today's agenda, what will the US role in this war between Israel and Iran be? And it seems as if we could be possibly heading towards another weekend of drama on that front, possibly with some escalation. Now, we do have our reporting suggesting that US officials are then preparing for a strike on Iran, but this is all subject to whether President Trump wants to go ahead with that. We heard him yesterday talking there about his views, saying it's very late to be talking with Iran, but saying the final decision has really not been made yet. He'll make that in the seconds before it is due.
The seconds before it's due, which on the one hand talks about how Donald Trump is thinking about this. On the other hand, talks about the severity of the situation and how large this is. If there was a strike on Iran, though, it's very clear that energy infrastructure would not be targeted. That's something that has been expected by the press because of the ramifications in the oil market as well. In previous iterations, though, he's also talked about not signaling some sort of regime change at all, or even targeting one on the idea that there is really no alternative as well. So ultimately, this comes down to one nuclear bunker that is underground and really putting the full firepower behind that as well. But even that is up for grabs. We're going to digest that throughout the show.
Right, and it does really come down to perhaps the framing of any US involvement here and whether it will be very limited and very specifically targeted at that very low-level bunker, and whether there can be an argument around very specific action there, or whether this is something much wider and is interpreted as such by the market and is interpreted as such by the region and by Iran, and that'll be crucial. You mentioned how energy would respond to that. Of course, we'd all be watching to see the Iranian reaction, whether there be any closure or even just disruption in the Strait of Hormuz. That'll be crucial. But maybe this is a non-starter, because we know domestically in the United States, the MAGA movement was not founded on going abroad and getting involved in war. In fact, the absolute opposite. And so he is getting some pushback in parts of that MAGA movement.
Absolutely, within his own party. We should also mention, however, I think feels like Iran can sometimes be the exception to that rule, given that he did actively campaign on the assassination of General Soleimani. You mentioned, though, however, how the region is going to be interpreting this as well. We should keep an eye, mention as well, that not only is the region, but also how European leaders are thinking about this as well. If negotiations with Iran are potentially back on the table as one possible scenario, what framework does that look like in terms of previous nuclear agreements, which European leaders were very much a part of?
Yeah, it seems like it's not the conversation for today, is it? You know, a replacement for JCPOA, but would it be a replacement for JCPOA? Let's move on to something else that's close to the market's thinking right now, Kriti, and that is the Fed, of course. I mean, so much for being data dependent, it would seem, because the Fed yesterday, the message there was about inflation is coming. This was quite a forward-looking, I thought, press conference, at least, from the Fed chair.
It's a fascinating one as well, because he's kind of saying, look, we don't know, which, surprise, surprise, nobody knows what the future holds. But he is saying, look, the economy is still resilient despite some unexpected jobless claims tick up as well. He is also warning about the tariff impact. And I think this is the very first time you've heard him very clearly say that there is some sort of inevitability when it comes to actually seeing that. We haven't seen it show up in the data yet. We've only seen it show up in things like import prices.
Yeah.
But he's saying that that is coming.
Yes, he is saying that is coming. And there was a really interesting conversation, wasn't there, about the reasons that it has not come yet. And he added thoughts into the mix around product imported before the tariffs and maybe being sold, therefore, at prices that don't fully reflect the tariffs. But that conversation obviously still to come. And the message very much from the Fed, wait and see. We'll learn a lot more about this during the summer. I thought it was interesting. Mike McKee asked a question about his role, about the Fed chair, about who sits in that chair. And he was quite keen, it would seem, to not get drawn into the conversation around what he thinks about President Trump's commentary on the Fed leadership, because President Trump has been very vocal on this front. But Powell was saying, look, this is not complicated. We stick to our goals, and I'm not thinking about the end of my term whatsoever.
I thought it was fascinating as well that in the lead up to this FOMC decision, Neil Kashkari, for example, over the Minneapolis Fed, said, look, this is something that's very hard to predict. It's very hard to see what the future actually holds. And this is something that is going to be talked about, I imagine, with the BOE as well later today.
Yeah, absolutely. So let's talk about where we go on the Bank of England conversation, shall we? Because here we have a central bank very much. I mean, yesterday I got notes post the Fed talking about, OK, well, maybe stagflation is where we go. Well, here we are with the Bank of England. And you can make arguments that the economy is slowing, and you can make arguments that price pressures are maybe not building, but aren't abating necessarily as fast as the market wants them to. So we've had jobs data, of course, 250,000 fewer jobs in the economy versus October of 2024. That's the weakening economy side of things here. CPI then yesterday at 3.4%. That was higher than had been estimated, broadly stable. Interestingly, Bloomberg Economics saying that it's not that sticky inflation. Actually, they don't see that as something that's going to stop the Bank of England from cutting rates. They see that there is that downward pressure on services inflation, and that services disinflation is intact, and so they see that as being quite crucial.
I thought it was fascinating that Dan Hansen, our chief UK economist as well, had made the point that keep one eye on oil in terms of the read-through into the UK as well. He said that the sensitivity that the BOE has traditionally pointed to is when oil prices hit an $85 a barrel mark. We're not there, but we're not far from that level as well. I'm curious if that's something that's addressed, that possibility.
Yeah, exactly. Anything they have to say on what the events in the Middle East mean for inflation and to read across into potentially higher rates in the UK will be watched. Divisions amongst the voters, that's also very key. And we saw at the Fed yesterday how there was such a range of views around the rest of 2025. And what will the range of views around policy look like at the Bank of England? They were really divided in May, ranging from hold to 50 basis point cuts. Will we get some dissenters today calling for a cut? Because the overall expectation, of course, in case we forgot to say, is that we don't get any change in policy.
Yeah, absolutely. And again, this is also, and I'm curious as we kind of evaluate and preview this decision as well, where the currency impact falls in all of this. Because if you are looking for some sort of stimulative impulse, how much of the financial markets are doing that heavy lifting for the BOE?
Let's tell you what is coming up on the programme today. We have great voices assembled to talk about all of these themes. Kim Crawford joins us, JPMorgan Asset Management Portfolio Manager, a great voice to weigh in on some of the central bank decisions we've had. We are still looking ahead to the SNB and the Bank of England, but we've heard from the BOJ, we've heard from the Fed, lots to discuss. Anna Rosenberg, Amundi Investment Institute, joins us, head of geopolitics. What are America's intentions? How can America's intentions be described? What narrative attached to them if we do see action over the weekend in Iran? And Nanette Hechler-Fayd'Herbe will be joining us, Lombard Odier's EMEA CIO. Great day to hear from Nanette, so we'll look forward to that conversation. And thinking about the BOE, we'll also talk to Matthew Swannell, EY Item Club, Chief Economic Advisor, weighing in on all things Bank of England.
Absolutely. Plenty conversations ahead. Really interesting ones. We have an all-star lineup to really digest through what else we've got on the agenda. Let me walk you through it. After the show ends at 9 a.m. UK time, we do have a Norges Bank rate decision. Remember, we got the Riksbank yesterday as well. A cut there. We're expecting a cut from the SNB, as Anna had mentioned earlier as well. So we are expecting that throughout the show. And then, of course, it is all about the BOE rate decision. So it is Central Bank Palooza today. And I imagine the read-through as well. We should remind our global audience that the U.S. markets are closed. So the bond market is not trading today. And futures are seeing very light volume and very light liquidity. So keep one eye on that as well. Plus, Geopolitics very much in focus. We've been talking about the Middle East, but EU finance ministers will also be meeting, I imagine, discussing the same topics we are.
Yeah, absolutely. Inflationary impact coming from the Middle East, perhaps on their radar as well. Let's briefly mention the SNB then. We are expecting to get a rate decision, and there is an expectation that we get a cut. We haven't had actual action and change in policy from many of the big central banks globally this week, but the SNB could be one of those. 3 out of those economists polled do expect the central bank to cut below zero today. That would require a 50 basis point or more, or at least more than 25 basis points to take us below zero. That's not the consensus. The consensus says we go to zero. But given the strength of the currency, given the weakness in inflation, maybe these things are possible.
It's fascinating, though, that in this era where we're talking about inflation, where we're talking about a risk to global economies, even the idea of negative interest rates for a major economy is crucial, especially one that is the beacon of one of the major risk-off currencies. And that is the outlier possibility of this entire thing, is that what if they don't cut at all? Because the SNB has been very quick to cut in the past, and that going to zero would leave very little room to maneuver should something like a recession or a trade war escalate as well. That is something that the currency markets aren't necessarily prepared for.
Let us tell you about some of the other stories that we are keeping track of this morning. Bloomberg has learned that Japan is considering trimming its issuance of super long bonds starting from July. According to a draft plan, the finance ministry is set to propose cutting issuance of 20, 30 and 40-year bonds. In total, they could be reduced by almost $700 million each per auction up to the end of next March. Bloomberg's been told Guggenheim Partners CEO Mark Walter is buying the Los Angeles Lakers at a record valuation of $10 billion. Sources say the Buss family has agreed to sell its majority stake in the NBA franchise to Walter, who already owns the Los Angeles Dodgers baseball team. The price tag crushes the $6.1 billion record paid for a professional sports team set in March by the NBA's Boston Celtics. Microsoft is planning to cut thousands of jobs in the latest move to trim its workforce amid heavy spending on AI. The terminations, which affect mostly sales roles, follow a round of layoffs earlier in May that hit 6,000 people and fell hardest on product and engineering jobs. And this does stem from the relationship between this business and AI. Its efforts on AI, it seems, to the fore, dictating those areas they want to invest in and those areas they may be less keen to invest in.
It's fascinating that they're going through the cycle again. We see this with all the hyperscalers. They invest so much money on the front end when it comes to data centers, when it comes to hiring in bulk, and then kind of pulling back on this. And we've seen this, how they've done this with infrastructure in the AI space. But now they're also talking about, at least according to the FT, about their future role in OpenAI. They've had a 49% stake historically. What does that future look like? We know that OpenAI has relied on Microsoft for a lot of their funding to push ahead that AI agenda. The FT reporting that Microsoft prepared to walk away.
We'll continue to watch that, of course. Kriti, maybe we talk through some of the things that are coming up in the show.
Absolutely. We have one eye on the oil markets. We also have one eye on commentary coming out of the big oil major. Shell CEO warning that they are cautious around transit through the Persian Gulf. We're going to bring you his comments throughout the duration of the show. Plus, as I said, central bank palooza. At the top of it, the Swiss National Bank saying measures aimed at strengthening the resilience of UBS are, quote, the best solution. We'll look ahead to today's highly watched rate decision. And up next, right back to the focus on the United States. Jay Powell held rates, but Donald Trump is not happy about it. What about the markets? We're going to dive into those details next. Stick with us. If you have any questions of your own for our guests or for us, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
Welcome back. This is Bloomberg's opening trade. Now, Federal Reserve policymakers voted unanimously to hold interest rates steady for the fourth consecutive meeting. Fed Chair Jerome Powell says there are lots of unknowns about the outlook for the economy, including the impact of U.S. tariffs.
Despite elevated uncertainty, the economy is in a solid position. We expect a meaningful amount of inflation to arrive in coming months. What's tended to happen is when there's turmoil in the Middle East, you may see a spike in energy prices, but tends to come down. The amount of the tariff effects, the size of the tariff effects, their duration and the time it will take are all highly uncertain. So that is why we think the appropriate thing to do is to hold where we are. The current stance of monetary policy leaves us well positioned to respond in a timely way to economic developments.
Jerome Powell there, and a lot of focus on how tariffs get passed through into the economy and who picks up the tab for those. Now, President Trump was quick to criticise the decision and continued to attack Jerome Powell.
Because of this guy's rates, you know, if he'd lowered a point, I'd pay about a point less. Then if he'd lowered 2 points, I'd pay about 2 points less. And that's for 10 years, 12 years, 15 years, 5 years. It's hundreds of billions, it's even trillions of dollars that we're going to lose because of this too late. I call him Too Late Powell because he's always too late.
President Trump's views on the Fed president. Well, let's get to Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management, with us on set this morning. Kim, very nice to have you with us. Let me ask you about the Fed then, and the commentary. Of course, it's become politicised. President Trump weighing in with his thoughts on where we go. But if we put his views to one side and just look at where rates are in relation to the underlying economy, your view as to whether they are appropriate and what we see next from the Fed.
Yeah, I think they're definitely appropriate. What we heard yesterday was really mission accomplished on a no-news message, and I think that makes sense given just how high uncertainty is. It didn't make sense for the Fed to swing the bat one way or the other. I think what they're doing is they have the ability or the luxury to stay where they are and then just be more reactive rather than proactive. You know, we're getting pretty good news or pretty soft news on inflation, but we also know that that tariff pass-through is going to come, at least in some parts, in goods inflation in the coming months. And at the same time, that means that the Fed's going to need materially weaker activity data in order to cut rates.
Yes.
And that's looking fine at the moment. You know, the labour market is loosening, but very gradually.
What about if President Trump decides to nominate somebody new to the Fed early? I mean, how would the market deal with that? How would you be thinking about that? Would that undercut the messages that Chair Powell is getting out into the market about having to wait to see the full impact of higher prices on consumers as a result of tariffs?
Yeah, so Powell's reign as chair ends May next year. We could find out earlier than that who his replacement's going to be. I think the market will expect a dovish kind of shift in regime, given what Trump is talking about. I would caution, though, that the Fed is still a committee at the end of the day. It's made of 7 governors and then also 5 Reserve Bank presidents that rotates on an annual basis. So that's going to temper the dovish shift to some extent. Also, you know, if you're a Fed and you're trying to be too dovish in the light of still sticky high inflation, that's going to make you lose credibility. And that's going to actually probably send 10-year yields higher rather than lower, which is not what they're trying to achieve either.
The markets are pricing in 2 rate cuts, though. What would those rate cuts come from?
Yeah, so I think our base case is that, you know, they probably do get ground out over time. I think if they come, it's because the tariff pass-through of inflation is just lower than we think, or the labour market picks up pace and it's weakening. It's still really weakening very gradually. So you've got a 3-month run rate of payroll still around 135,000. I think that's going to have to go a lot closer to zero or negative for the Fed to really pick up pace.
You mentioned the payrolls data. The jobless claims data was significantly stronger than everyone expected. How should we be interpreting labor data or jobless claims data, even ADP data, in the context of inflation risks, geopolitical tensions, et cetera?
Yeah, I think the bar, because inflation is high, then what you're looking for in the labour market has to be weaker than what you would usually do in order for the Fed to react to it. You mentioned jobless claims. Continuing claims is something that we're looking at closely because that's really been on the rise. But we are looking at the whole mosaic of data. So things like JOLTS, things like Indeed job openings, alongside payrolls and claims. There are some seasonally adjustment issues in claims data at the moment. So I think we just have to be a bit more cognizant of the bigger picture as well.
Yeah, I thought it was interesting that Powell was asked yesterday about the immigration policy and what that's doing. And he was clear to point out that, yes, there would be some reduced supply of labour to the economy, but he also saw slight reductions in demand. So he didn't seem too concerned overall about the impact there. Can I go to Japan then, Kim, and ask you about your stance there? Because Japanese bonds, we've seen an update essentially coming through from the Ministry of Finance talking about the amount of issuance they're going to do at the long end. And there's been a lot of nervousness about the long end of the Japanese curve, and that to some degree spilled into other global bond markets, didn't it? And just a real nice illustration of people's fiscal concerns, I suppose, and especially around the long end. How significant are these announcements today?
Yeah, so the Japan curve has really out-steepened and aggressively steepened global markets in the last 2 months. I think it presents actually quite an attractive opportunity here. So yeah, like you said, today we heard from the Ministry of Finance that maybe tomorrow we'll get a bit more details on their discussions with primary dealers. We see it more of a demand-supply imbalance amidst high volatility. You know, if you look at domestic buyers of long-end JGBs, they've pretty much disappeared in the last few months. So they're waiting for some calm in the markets as well, and for the Ministry of Finance to come in and reduce that long-end issuance. I think what we're hearing today, this morning, about a 10% cut, if it's true, I don't think that's going to be enough to calm the curve. But next week, the Ministry of Finance is going to meet with other investors as well. And I think it's still an ongoing discussion back and forth before July, when we actually get the final announcement.
Essentially, that it might not be enough, because, Kriti, we had a Japanese bond auction just this morning, in fact, but it was at 5 years. It's a 5-year horizon, so not the area that everybody's worried about, but that seemed to show pretty solid demand there.
Yeah, absolutely. But it brings about this question of issuance as well, and connecting the BOJ with the Federal Reserve, if you'll let me. In terms of this issuance story, because there's also speculation that Scott Bessent is looking to also move some of the issuance to the front end of the curve. The BOJ has historically been a little bit of a case study in central banking for the rest of the world. Does that work? Does moving issuance on various ends of the curve work?
I think it can help reduce volatility. It may not necessarily bring your level of yields down. I think the UK is a good example as well. You know, we had the DMO a few months ago really significantly reduced that long-end issuance, and I think they understand that demand-supply imbalance as well, as the pension industry has evolved over time. And you've seen since then that the UK curve, which has historically been really high beta and steepening, just reduce that beta. So I think it can reduce volatility, and then it's down to the fundamental data on just how far it can actually bring down the level of yields.
Kim, I think you like gilts. Is that correct?
Yes.
That's still correct. You're checking that's still the right information. And so where are you focused? We talked at the top of the programme about the deteriorating labour market environment, but and the deteriorating economic environment into the second quarter. But then you also have this sort of persistent inflation.
Yes. So UK inflation is still higher, especially in services compared to a lot of the world. But I think what you're starting to see, which we're getting a bit more excited about, but not really going all the way in either, is just that pickup in pace of weakening in the labour market. And if you do get that, I think it can pull down inflation pretty quickly. The ONS has told us that the last figure that we got, which really pulled employment figures down pretty sharply, was taken earlier in the month than it usually is. So we do expect some revisions to that. But it's that labour market story that we're really looking at to pull services and wage growth down. And the big question for me is when the Bank of England can start to pick up pace from that quarterly rate cutting pace. And that's going to be down to how quickly the labour market continues to loosen, how quickly that feeds through to wage growth numbers, so how quickly that can come back to more 3% or a little bit higher, consistent levels, and then also how inflation expectations remain anchored in light of oil prices.
Kim, 30 seconds. Does the gilt market need to be pricing in an oil shock at this stage?
Not at this stage. I think it's incredibly difficult to say how the conflict ends. We know that if the Saudi oil infrastructures get hit, or the state of or the channel of Hormuz gets closed, then you're going to see oil prices skyrocket materially higher. Where oil prices are today and natural gas prices, it's going to probably push the Bank of England's headline inflation forecast up by about 0.2, 0.3 percentage points. And it's something at that point the Bank of England will still be able to look through.
All right. Kim Crawford, Global Rates Portfolio Manager at JPMorgan Asset Management, quite literally taking a tour around the world with us. We thank you so much. Coming up, we're going to continue that conversation on oil and the broader implications as U.S. officials prepare for a possible strike on Iran in the coming days. We're going to talk about what that means for the widening conflict in the Middle East, as well as the ripple effects into these markets. Stick with us. Don't go anywhere. That conversation next. This is Bloomberg.
Welcome back. This is the opening trade. 30 minutes until we get the opening trade here in Europe. So with that in mind, let's check in on the European equity market futures picture. Of course, we don't have US cash trading later today because it's a public holiday in the States, but futures markets are open stateside, and we're down around 0.3% on US equity futures. We're down a little more than that on some of the markets here in Europe. So CAC 40 futures, for example, down by 0.6%. It seems then, Kriti, that nervousness around the Middle East and a focus on maybe inflation impacts still to come post the comments from Chair Powell yesterday at the Fed, all of that weighing on sentiment a little bit this morning.
Absolutely, and I should say that we don't really actually have a read in terms of the bond market pricing for the United States. Those markets are closed today, but you are seeing plenty of movement when it comes to the moves in Europe, and I think that might just have to be with the slew of central bank decisions that we have on this side of the Atlantic. The German 10-year higher by about 2 basis points this morning, almost 3, move higher certainly in France and Italy as well, to the tune of about 4 basis points. So certainly that nervousness you're seeing in the equity market showing up in the bond market as well.
Yeah, absolutely. So let's go to the source of some of that nervousness, all, of course, concerning what's going on in the Middle East and the US response to it. Bloomberg understands that senior US officials are preparing for a possible strike on Iran within the next few days. This, as President Putin says he is in contact with both Israel and the United States to try to facilitate dialogue between Iran and Israel. Let's bring in Bloomberg's Jemana Besetcha, who can bring us analysis fascinating the role that Russia is playing here, Jemana. So let's think about the US and the reaction function there. The US is perhaps thinking about getting involved. President Trump seems to be keeping his options open at this point.
Yeah, well, ever since President Trump departed G7 summit, there have been lots of questions as to what the U.S. are thinking about doing in this war that has been raging almost for 7 days now. Bloomberg understood from senior U.S. officials overnight that the U.S. indeed is preparing plans to attack Iran in the coming days. It could happen as soon as this weekend. But I should also emphasize that those officials said the plans are still fluid, they're evolving. Another White House official said that all options still remain on the table. What we do know is that in the last 24 hours, President Trump's stance towards the situation has hardened. Remember, he demanded that Iran, quote, unconditionally surrender in a post a couple of days ago. He also said that he knew exactly where the Ayatollah was hiding, but that they had spared them for now. So some perhaps tacit threats coming through there. Now, what they end up doing, obviously, is up to the U.S. president. But Iran, on their part, have also responded. The supreme leader yesterday in a televised speech said that they will not capitulate. There will no be unconditional surrender. They will fight back. And they're watching very closely to see if the U.S. do get involved in this bombardment, because if they do, they will strike back at U.S. assets as well. So there is a lot of nervousness in the region about what could happen in the next couple of days. In the meantime, the attacks between Iran and Israel continue. Israel have struck 20 military targets in Iran overnight, including some of those nuclear sites. More nuclear sites are being targeted and defense sites. And just in the last couple of hours, one of the Iranian missiles directed towards Israel managed to penetrate the air defense system. An Israeli hospital has been hit. The latest numbers suggest that more than 40 people have been wounded.
All right, Bloomberg's Jemana Besetcha joining us out of Dubai to give us the update in terms of the escalating conflict. We thank you so much. Let's bring in Anna Rosenberg, head of geopolitics over at the Amundi Investment Institute, for a little bit more analysis this morning. Anna, pleasure to have you on the program. Good morning. I'm going to pose a question to you that we posed to Jemana. What are the odds that the U.S. gets involved right now?
I think the odds are quite high at this moment in time, and this is simply because, frankly, for the U.S., this is a unique moment to take out a big geopolitical headache, which is Iran potentially developing a nuclear headache, and also this deepening relationship that we saw between Iran, China, North Korea, and Russia over the last few years. That is the biggest geopolitical threat for the U.S. So right now it finds itself in the position where Israel has destroyed some of Iran's military capabilities, missile capabilities, and where the Iranian militias are quite weak in the region. It's probably going to be difficult to find a better moment for the U.S. to act, right? Having said that, acting comes with a lot of consequences too. So this is why the odds are relatively high and why Trump will have to make a real difficult decision.
Well, can you talk to us about those consequences? We've heard from Iranian officials as well talking about being prepared to have repercussions to act on U.S. military bases and Israel as well, should the U.S. get involved. But walk us through the potential scenarios there, even if it is a targeted attack or one that involves regime change.
Well, I think the regime change scenario is one that Israel is already working towards, in the sense that they are, slowly undermining the regime's capabilities. We've seen a lot of assassinations, right, of the Iranian leadership. That will likely play out, but mostly instigated by the Israelis. The question is, what type of regime change do you get? Do you just get a change of the leadership and you still have the same regime in place, maybe a more moderate version? That is probably the most likely scenario. A real different regime is going to be quite difficult to get. So that is less likely in the scenario. But let's talk a little bit about the repercussions that we could see from Iran. The thing is, we don't know what capabilities Iran still has at this point in time. This is the big unknown. There could be more secret capabilities, weapons that we don't know about. Nevertheless, based on what we know, which is that Iranian missile capabilities have been reducing over the last few days, it's likely that they will primarily strike U.S. assets in the region, in Iraq specifically, right? And you would see Hezbollah get involved to some degree, the Houthis get involved to some degree. But again, they have, we have a couple of different scenarios here. The Houthis have a ceasefire with the U.S. Hezbollah is weak. So it's really Iraqi militias right now. So the chaos that they could create is probably quite limited.
OK. And yes, we were hearing from even some of the organisations that are charged with policing global nuclear capabilities aren't sure exactly what Iran has and where at this point. And can I ask you about Russia's role in this? Because there hasn't been much said about how they might support Iran. And until just this morning, we heard actually from the Russians saying, look, we're not sending any weapons to Iran. They haven't asked for any. And instead, we hear commentary that the Russians would like to mediate here. Now, that might seem strange in a pre-Trump presidency, but we know that President Trump and Putin have spoken a lot, and I wonder if that's shifting things around. So what role do you think that Russia wants to play here?
Well, Russia wants to stay out of it first and foremost, and it's an opportunity to be in the good books, right, of the U.S., to see like a peacemaker.
It does want to stay out of it, so it doesn't want to support Iran here.
And no, I don't think that it's at this point willing to risk anything for a regime that's already quite weak and has been also weak from inside for a while, right? This is an opportunistic friendship. Now, if that friend leaves, you're not going to fight for that friend. You're going to make new ties with the regime that comes in, like Russia is doing now in Syria, too. So you adjust. That's what happens in geopolitics all the time. You reach out to whoever is next in charge, and you don't get involved. Russia doesn't have the capabilities right now to get involved. So I think clearly for them it's not great, because this perception of deepening ties to a near-nuclear Iran was a very good thing as like a deterrence power for Russia. So it's not great from their perspective, but they're not going to put their neck on the line for the Iranian regime.
OK, that's really interesting. And how do you think, if the US does choose to get involved, how do you think the United States would frame that involvement? Would it be very limited to taking on specific nuclear installations and achieving things on behalf of Israel in those very specific locations, trying to downplay direct combat between the United States and Iran?
Yes, I think that's what it would be. It would be focused on trying to take out the nuclear capabilities that are alleged in Fordo, in the deep underground facilities, as far as we know, with what the US calls the bunker buster bombs, right? Because that's the capability that the Israelis don't have. I do not expect that the US would get involved beyond that. Of course, if there would be attacks on US assets in the region, there would be some retaliation too.
Would Iran not retaliate as much, given that limited role for the United States? Do you think the Iranians would flex their response based on how severe the involvement of the United States is?
It really depends on the capabilities that the Iranians still have, which we don't know. So that is really the key issue here. I think that it's something we have to figure out very closely. But it looks like, as I said before, the Iranians are still, I think the diplomatic route is not closed either. Yeah, this is still, the Iranians ideally want to survive this. The Iranian regime wants to survive this. The best way to survive this is to get some kind of diplomatic agreement, right? If that doesn't happen, then they'll probably try and go down fighting, if you will. And that's when we have the risk of potential asymmetric strikes, when we could see some temporary disruption on oil as well, with some intimidation of vessels in the Strait of Hormuz. So those are kind of the scenarios we're looking at.
I really want to dive into the diplomatic possibility in just a moment. But before I do, just to follow up on a comment you had made earlier, you had said that specifically if Iran does retaliate to any sort of U.S. involvement, it would be focused in Iraq specifically and potentially on U.S. bases. Is there a risk of retaliation in the GCC, retaliation, other energy infrastructure to the south?
Yeah, the risk clearly persists, but we have to keep in mind that, again, the Iranian regime has improved its relationship to Saudi Arabia specifically, and it doesn't serve its interest right now if the prime goal is regime survival to deteriorate relations with your neighbors. So I think that the risk that they go after Gulf infrastructure is limited at this point in time. They would first and foremost go after Israel and the US. And disruptions of vessels in the Strait of Hormuz, I think. But to actually go for the Gulf assets, that would be a very last resort kind of situation.
So let's talk about the best case scenario, which is that diplomatic solution, if we can. We've been talking a lot about what a nuclear agreement may actually look like in this environment. If there are elements of the old JCPOA that might make some sort of resurgence, maybe not in the exact format, but elements of it, what does a diplomatic solution look like?
Yeah, this is why actually the timing of this attack didn't really make a lot of sense, because it was possible to get an agreement. You can fudge the nuclear issue. You could have fudged it fairly easily. You could have said, for example, Iran could have said, oh, we're not going to do any kind of nuclear enrichment for the next few years. We're going to pause the program. And that's it, right? You could have agreed to disagree. You could have increased monitoring. But clearly, that was not what Israel wanted to do either. And I think that ultimately, at this point, you would need a firm commitment from Iran to step away from all its nuclear capabilities. Given that the Iranians have to choose between regime survival or holding on to their nuclear capabilities, I think that's the path that we're talking about now, right? But we have to keep clear, if there is no significant regime change, if there is no real decimation of Iran's nuclear capabilities, then you'll likely see the risk of Iran's nuclear capabilities increase over the next few years, because you can't bomb away the knowledge.
Yeah. A final question to you then, and I'm going to broaden this out from a 60,000-foot view here. We are openly talking about regime change, assassinations, U.S. involvement here. Should other authoritarian regimes around the world watch how the U.S., I imagine they are already, but watch to maybe an extra extent how the U.S. is talking about regime change in Iran? I'm talking about Maduro, Kim Jong-un, other authoritarian regimes around the world that are saying, is Iran a case study for how the U.S. could attempt other parts of the world?
Well, clearly, I don't think that it's going to be a blueprint, right? The concerns are very different. However, you touch on a very important point, and which is that Trump is showing himself, to be able to act beyond imagination to some degree, right? And this comes after we thought it was about chickening out, right? It was about always chickening out. So he's doubling down, and I think that will cause other, enemies of the U.S. to rethink what they're doing to some degree, and it's trying to reestablish the U.S. deterrence. I think that's where we are. So the U.S., I think, has to be taken seriously still, right? But I don't necessarily think that it's going to be a blueprint for how the U.S. acts with other leaders. Clearly, there's a lot of negative history of regime change. Regime change causes a lot more chaos most of the time.
Anna, thank you very much. Thank you for coming to speak to us about the region, about the possible involvement of the United States. Anna Rosenberg, Head of Geopolitics at the Amundi Investment Institute. Coming up on the programme, 7:43 here in London, we'll get back to some of the corporate news flow this morning. Nestle extends its leadership overhaul with a new chairman. More details in our stocks to watch. This is Bloomberg. Welcome back. This is the opening trade, 7:47 here in London, and risk appetite seems to be deteriorating a little as we approach the start of the trading day here in Europe. We see DAX futures, CAC futures down quite considerably. Let's talk about that. Our Markets Live executive editor, Mark Cudmore, is with us. Mark, another day where we see nervousness in equity markets, probably driven by what we see in the Middle East and the potential for US involvement there. So European futures down, US futures down, but we will be without the liquidity there, of course, because we don't have US trading. What are you watching when it comes to that overall risk appetite story?
I think it's going to be an overall directionless day. We've got some micro themes given all the central banks on tap, so it's going to be exciting for day traders. But I'm not expecting a new macro theme yet. I think the backdrop picture here is the Fed sent us a message saying they're worried about the stagflation risks, but they're not going to try getting ahead of it. And I think that's a slightly negative message overall for stocks, for the dollar. It's not helping the whole general kind of negativity around US assets, but no one wants to trade it aggressively in the low liquidity. So I still think we're kind of drifting along, waiting for the next big catalyst. And I think it's more likely, given where we're priced, given how optimistic people are on trade, on the tax bill, I think it's more likely that any big next surprise catalyst is a negative one that comes up. So we're kind of waiting, playing the short-term central banks in the interim.
Well, in the meantime, let's focus on one central bank in particular. I think of the Fed, the BOE is getting a lot of attention. But, Mark, I have my eye on the SNB. There is a possibility out there of negative interest rates, not the consensus, but a possibility of negative interest rates out of the SNB. In this environment, can you just walk us through what negative interest rates might mean for a risk-off currency like the Swissy?
What's amazing about the Swiss franc is theoretically a currency, but in reality it's a financial asset. In the same way that gold is theoretically a commodity, but in reality it's a financial asset. The closest comparison between those two assets is each other. Gold and Swiss franc are both portfolio diversification assets. That's what they really are. And those trump the fact that the Swiss franc is theoretically a currency and trump the fact that theoretically gold is a commodity and used in jewelry. And they both, in a world where one of the world's most important kind of haven currency and most liquid, and the one most important haven assets in treasuries are both getting a little bit undermined at the margin. Let's not be dramatic about that. That means that people are seeking more of these alternative havens. And Swiss franc and gold both qualify in that regards. So the reason I give all that preamble is essentially the Swiss franc does not trade like any other currency. Fundamental inputs don't drive it. It drives on geopolitical factors. So really, whether rates go negative or not won't decide the future of the Swiss franc. At some point, we're going to go, hey, we want to be more risk-loving and we're going to bail out of the Swiss franc, but not while there's so many risks around the world kind of keep on flaring up every week.
OK, yeah, having to deal with all of those global dynamics in their own domestic situation. Mark, let me ask you about the dollar. We see the dollar stronger today, not by much, but up 0.1% or so. Has it found renewed haven status here through this geopolitical tense period, or is this more about Fed policy?
You know what? I've been so disappointed by the dollar price action. As you know, I'm a structural dollar bear, but I thought we'd get a bit of a short-term dollar squeeze higher. We've got a little bit of one, but not much at all. And I have to say that the Fed message last night, the stagflationary message, isn't particularly positive for the dollar. So I feel like the short squeeze is running out of ammo very quickly. And that emphasizes the fact that the world is structurally overexposed to the dollar, even if fast money is short at the margin.
All right, Bloomberg Markets Live executive editor Mark Hudmore, drinking out of a fire hose when it comes to the central banks and the ripple effects there. We thank you so much. You get more up-to-date analysis from him and the team. MLIV Go is the function on your terminal. Let's go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So we've got a bit of a change at the top of Nestle, which has got a new chairman coming in. He is known for his time over at Inditex at Zara, so swapping fast fashion for Kit Kats and pet food and Nespresso coffee. His name is Pablo Issa, and he is known for turning around the Spanish fashion company, which is what Nestle actually needs, because as we can see, while the company has had a decent start to this year, longer term, Nestle has really underperformed, given concern around pricing and also some overstocking in some of their markets as well. We can see that stock down more than 20% on a 5-year basis. So Pablo Issa coming in, potentially going to be seen as a positive by investors this morning. Keep an eye on that one in Switzerland. Then we've got Zealand Pharma over in the drug space. Now, the company last night announcing some weight loss drug trial data. Now, people using the drug lost around 12% of their body weight, just below that, over a 28-week period. Now, this is pretty much comparable with some of the big drugs like Wegovy from Novo Nordisk and also Zepbound from Eli Lilly. So pretty strong numbers in terms of how much weight people were able to lose with that. In terms of the stock, we can see that's rallied around 300% on a 3-year basis. But like Novo and Lilly, we have seen the stock coming down from its highs recently. Potentially this could be a driver of a bit of relief after that downside in that one. Then over in hotels, we've got the Premier Inn owner Whitbread. Now looking a little bit weak here in the UK. People not doing enough travelling, doing enough bookings at hotels. So that is soft. But Germany, really strong. That stood out for me in the report. German sales are up around 13% in the latest quarter. We can see it's been a bit of a struggler as well this year, down around 5%. Has recovered off the lows recently, but potentially Whitbread. Bit of a mixed report. Weakness in the UK, probably the main takeaway on that one today.
Joe, thank you very much. So a host of stocks to watch this morning, some individual names that could be on the move then, Kriti. Let's talk about the global picture. The sentiment picture is negative. Eurostoxx 50 futures are down by 0.8%. It seems that more of this negativity might attach to Europe than elsewhere from an equities perspective. But we're also looking at corporate credit risk as well. The cost of insurance against corporate bond default, so that measured by the iTraxx Europe, in Europe is rising in early trading today. And this, of course, all as US officials have been given the green light to at least make preparations for some kind of attack on Iran, even if the actual green light is never given for that attack to be made. But behind the scenes, preparations are being made. And you can see that tick higher on the chart on the screen at the moment. There's other places that this is showing up in the financial markets. I think I wrote a story this morning about insurance rates around shipping. Some of the shipping rates through the Strait of Hormuz that are getting retraced, they're starting to pick up higher and actively pricing in this geopolitical risk in the commodity sector, which, speaking of, as we were talking to Anna Rosenberg earlier in the program, oil is ticking higher. We're now at a 77 handle, 77.24 on Brent. Remember, we've hit that kind of ceiling of 78 from a technical perspective. So as we get more headlines, more clarity on what the plans around Iran are from the White House, but also from other regional powers as well, that's, of course, going to be a commodity that we keep an eye on and one that's already been reflected in these equity markets. Yeah, we see gas prices in Europe edging up 3% as well this morning. So a little bit of a move higher. Iron ore prices up 0.8%. So perhaps this will be something that plays to London's strengths rather than the rest of the European equity markets, where we do see futures, as we've been saying, pointing, substantially to the downside. Nervousness around the role of the United States in what is taking place in the Middle East. Coming up, we'll bring you the opening trade. Futures are pointing lower. We are without the United States, though, today, so perhaps a few traders at their desks. We will see. This is Bloomberg. Welcome back. This is the opening trade this Thursday morning. A few minutes until we get that opening trade. Let's put yesterday's session in context, because that does still actually have some importance for us today with our European session ahead. So this is the volatility we saw and the general slight weakening we saw through the European session yesterday here in the white. Over in the blue, we have the US session of yesterday. And just towards the end of the day, you see the drop in risk appetite. And that does chime with when we were hearing from the Fed and we were hearing from Jerome Powell around his concerns that inflation is still to come. The pass-through of higher tariffs onto the US consumer. We don't know how much of that is going to happen yet, he said, but it is still to come. There will be some of it, and that seemed to weigh on sentiment a little bit as we got towards the end of the US session, so we were sort of back to the flat line. Then this is the European futures picture. So this is a mix of geopolitical concerns around the US role in the Middle East. Will the US join in with Israel in its attacks on Iran? That's still very much an open question. The market is watching that, Kriti, but the market is also digesting that little bit of negativity at the end of the US session yesterday around the Fed. Absolutely. Lots to digest in these markets. Light volume, light liquidity, given that the U.S. is off today. We will see how that magnifies or maybe minimizes some of the moves at the opening trade. In the meantime, a couple of individual stocks to watch as well. I'm going to start from the bottom up here. Shipping stocks very much in focus as we talk about that geopolitical risk emanating out of the Middle East. We've already seen it show up in credit spreads. We've seen it show up in insurance costs. That is likely to show up in some of those shipping names as well. Working our way up there, Barclays and TSB very much in focus. We know TSB currently owned by Sabadell, which is, of course, pushing the deal or the hostile takeover bid from BBVA. Some reports that Barclays may be interested in that takeover. We'll see how the market interprets that in just a few minutes. And Nestle as well in focus, Anna, getting a change of leadership, this time from Inditex. OK, so food to banks to shipping, very much in focus, and really interesting comments from the Shell CEO, which we'll get to during this hour, of course, around the Straits of Hormuz and the impact that any disruption there would have. So European equity markets open now. The FTSE 100 just a touch to the downside. Maybe that's not where the focus is going to be in terms of downside, though, because we've seen oil prices going higher. We see gas prices going higher this morning. Some iron ore moves to the upside, too. And that typically would support the London market at least a little little. There could still be downward pressure, of course, coming through from the Fed narrative and the geopolitical concerns. So all of that could add up to a slightly more resilient FTSE 100 than the rest of the markets. That's what the futures were suggesting, and that seems to be what is transpiring here. So the FTSE 100 down by 0.3%. Elsewhere, down more than that. So the DAX and the CAC 40 then, Kriti, down by 0.6%. So we're dealing with, yes, the geopolitical concerns, but also a little bit of an adjustment, perhaps, around the Fed and our expectations of how sticky, how much the Fed is going to be focused on the inflation dynamics from here.
Absolutely. And of course, as we digest through that weakness that you're seeing in the broader markets, and as expected, it's not showing up in every single sector. You are seeing broad red across the screen. But if you look at the energy sector, that's where you're trading the outperformers. No surprise there. The geopolitical risk certainly magnified in terms of risk sentiment from the broader index perspective, but also to the upside when it comes to some of these individual movers. So I'll go right to it. Shell, BP, your typical oil majors, and Total even moving this market higher, working against the grain here. We know we heard some comments from Shell as well in terms of preparation around some of the oil transportation costs as well. That's in direct reaction to risks around the Strait of Hormuz. But the rest, Anna, a very risk-off day, a very low volume, light liquidity kind of day.
Yeah, and it's interesting that energy and basic resources move in the opposite direction. So energy names, yes, absolutely, moving higher this morning. That is the only sector in positive territory. So energy stocks up by 0.5%. Basic resources, the worst performing sector, that's down by 0.9%. Rio Tinto is weaker. Antofagasta, Anglo American and the like, they are all weaker this morning. And I think that's interesting, given that I think earlier I saw that we were a little firmer on iron ore prices, but just pulling that up now. Yeah, we are up by 0.7%, but that's not what's driving things. I suppose it's a sentiment trade.
Absolutely. And we should mention that there is a dollar component to all of this. In fact, you are seeing a dollar strength story today as well, and it coming in tandem with some strength in the oil sector as well. We tend to see that together. It signals signs of stress in these markets, which, no surprise, is probably feeding into that risk sentiment. So how do you navigate it? Let's bring in an expert here this morning. Nanette Hechler-Fayd'Herbe, Lombard Odier's EMEA CIO, joins the program this morning. Nanette, a pleasure to have you on the program. Thank you for joining us. We're trying to weigh all of these geopolitical risks and what that means for the equity markets. Walk us through your initial take of how we should be thinking about it.
I mean, it's obviously always a very tricky situation because when relying on the past, these type of escalatory movements in geopolitical terms tend to be transitory. And therefore, in terms of strategy, at the moment, we have certainly navigated it by keeping a steady hand, understanding where we have in the strategy diversifiers. So we have held to a relatively constructive global equities view together, however, with an overweight in fixed income in case we are having a risk-off period. Government bonds, in our view, would be helping. So diversifying the portfolios at a time when there is a lot of uncertainty, very fluid situations, is just a very basic thing to start with.
Nanette, at the core of this, in terms of how the markets are viewing not only geopolitical risk in the Middle East, but also the trade negotiations that are happening in the background with the United States and other countries around the world, is ultimately the inflation risk. And we heard from Jay Powell that ultimately those risks are to the upside and really bolsters the case not to cut. But Nanette, the market is still pricing in 2 cuts from the Federal Reserve by the end of the year. But that's priced into the bond market. Is it priced into the equity market from your point of view?
I think that at the moment, it's really quite consistent with the fact of this transitory nature of inflation risks. In particular, when you take a look at the 10-year break-even inflation, so a long-term inflation expectations measure, it's been extraordinarily stable. Bond market is pricing the pressures from the tariffs, for example, as something that is transitory and that will wash out over time. Not too dissimilar from an increase of VAT, for example, which is a little bit more usual for other times and other markets. And then I think that now, with respect to the energy prices, what is really critical is that this very tense situation indeed remains transitory, because in the past, prior to the escalatory moves here, energy prices have been on the way down. So that is certainly something that we will have to validate over the coming weeks in order to continue having a bond pricing of currently transitory inflation moves higher and then stable long-term inflation. This needs to be validated.
Nanette, let me just park the conversation around rates for a moment. No doubt we'll return to it. There's a lot of central bank news this week. But I just want to ask you about geopolitical nervousness and how that's feeding into your thinking here. Because the big question for markets right now seems to be whether we see the US getting more involved in or directly involved in Israel's war with Iran. If maybe this all will depend on the extent of that involvement and what narrative goes along with that. But which are the assets that you're going to be watching for here? I mean, the obvious ones around oil and gold, of course. But then I'm interested in what the dollar might do, other havens, because we actually see the dollar on the rise a little bit today.
Yeah, it's always very difficult to base an investment strategy and also views on geopolitics, because these geopolitics can just change fundamentally from one day to the next. So I'm not paying too much attention now at the short-term movements here. I think that in the immediate, if there was an involvement of the US, it would definitely be detrimental to risk assets, because that is just yet another stage in this conflict that is going to spur risk sentiment. I would expect the VIX to increase, so volatility of US equities to increase and reflect that, that just increased overall geopolitical risk. I would also expect safe havens to immediately react. You mentioned gold. That's a natural safe haven, although it's been really going the other side in just the last 24 hours, in spite of escalatory comments, for example. Another safe haven is absolutely the Swiss franc in the currency. On the currency side, perhaps even more than the US dollar, the Swiss franc would probably rally. It's very relevant because today the Swiss National Bank is having its mid-year policy review, and it will have absolutely an implication for interest rates and for investors in Switzerland as well. And then within equities, what are the type of assets, if you like, that would be on the one hand the most negatively impacted is those that are in economies that are very exposed to higher energy prices. So these are typically European economies, but also some of the Asian economies. So we should be expecting some downward reactions on those, while energy stocks on the other side, you mentioned it in the opening, would be just benefiting from just higher prices for now.
Okay, great. So those are some of the things we should be watching for. I'm actually looking at luxury stocks a little bit weaker this morning, Nanette, and we saw some data around Swiss watch exports falling 9.5% in May, and this being attributed to the US downturn. I wonder if that, as a theme, has further to run, some US weakness at the luxury end.
I think we have to be careful. There is certainly some noise in these data that is coming also from the tariffs. What of the orders have been just front loaded, and what is just the month to month change here. So I'm expecting that on the luxury segment there is still some impact from the whole trade policy uncertainty from the United States. But coming back to the current situation, I mean, if there was an escalation really to the next level that would disrupt the trade of oil at a broader scale than what we have seen so far, it would have an impact on the overall global economic growth. And any sector that is cyclical, like luxury goods, like also you mentioned materials, for example, very cyclical area and sector in equities, these would all probably have a reaction that is reflecting slower growth.
In an era of slower growth, though, Nanette, how are we thinking about the narrative, or how are the clients you're speaking to thinking about the narrative that Europe is still potentially an outperformer relative to other international markets this year?
I mean, Europe tends to be cyclical. We refer to it as a high beta market within developed markets. It's a bit like the big Asian cyclical market. So if you're going to see an overall slowdown, those markets that are particularly cyclical, take, for example, the DAX in Europe, which has a higher component exposure to industrials, that would probably come back from the extraordinary performance that it has had since the beginning of the year. And then within Europe, there are obviously some markets that are much more domestically focused and that are not so, in the end, so cyclical. Some of the peripheral markets, for example, in Europe, whether it's Spain, whether it's Italy, these are some examples that might actually decouple a little bit. So we will have to make distinctions of cyclical markets, just according to how much of it is domestically driven versus how much of it is exposed to global growth.
Nanette, thank you so much for your time. Nanette Hechler-Fayd'Herbe, Lombard Odier, EMEA CIO. Let's look at the core six then. How are these heavyweight stocks in Europe performing this morning? We've talked about some of the weakness in the luxury end of things, and you see that there represented with LVMH. We're going to get some more analysis a little later in the programme on that particular sector. That's the worst performer in the core six. Tech also a little on the back foot, down 0.9%, but really most sectors in negative territory as we see Stock 600 down by 0.6%. Let's get a check on the individual stocks this morning that are on the move. Joe has a rundown. Joe.
So one sector looking really weak today, Anna, is recruitment stocks. We've got an update from Hays here in the UK. That stock declining 14%, really negative commentary around the staffing market, not just in the UK, actually across all of their regions, pointing to Europe, pointing to Germany, Asia as well, and North America. So really negative commentary in terms of both their fees and the demand for their services. And we're seeing a feed through into Page as well, not just in London. We're seeing it feeding through to Randstad over in Amsterdam and Adecco in Switzerland. Big moves across that sector today. Recruitment really weak following that update from Hays. Then we've got the watchmakers, and I mentioned that one earlier. We've got some data out of Switzerland. Exports, some of the sales looking like double-digit declines on some of those markets. So we are seeing weakness in Swatch, the big company over in Switzerland, as well as Richemont, also Swiss-listed, of course, the maker of Cartier watches, and also Watches Switzerland a little bit lower as well. Then we will turn as well to an area we don't look at too much, is Swedish forests, because Stora Enso potentially going to be spinning off around $7 billion worth of Swedish trees, according to a statement. Now, that stock gaining 14%, that is actually the best performer in the entire European market today. Now, a lot of these packaging paper companies, they actually own the forest where they get the paper, so it's pretty interesting when you dig down to it. But that stock getting a decent boost, up around 14% at the moment for that one. And then another big gainer over in Paris, Eutelsat. News that they've got a deal with the French military on satellite services. Remember, this one was in focus when there was news around Starlink and Elon Musk and potentially the US pulling out support for Ukraine, and there was a lot of volatility in this stock back then. It rallied a lot, and now we've got news of this deal. It's potentially worth around $1 billion for this pact with the French military. So Eutelsat really rallying today. And finally, Whitbread, that was a difficult one to call at the open of trading. We are seeing it down now. The UK did look soft. The UK sales were down a couple of percentage points. Premier in, well, everything is Premier apart from the share price. I think we've done that one before, but I'll do it again. Germany looking pretty strong, but Whitbread declining today, saying their 5-year plan is on track, but shareholders not taking much notice. That one is weaker in London today.
All right, Joe Easton from our equities team, we thank you so much for walking us through some of those early movers. But as we look at this market, there are a couple of luxury names that are weighing the entire market down. LVMH at the top of that pile. We're going to dive into that company next as they confront one of their worst crises in their history. We're going to break down the challenges at the luxury giant live out of Paris. Stick with us. This is Bloomberg.
What is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Straits of Hormuz is, at the end of the day, the artery through which the world's energy is flowing.
Shell CEO there speaking to Bloomberg's Sherry-Ann at the Japan Energy Summit, an exhibition that takes place in Tokyo, and really setting out the stakes in terms of the oil market specifically around the Straits of Hormuz and the future developments in that particular region. Let's talk about the oil market and what we're watching for now. Bloomberg's Stephen Stapczynski joins us. He's at that same energy summit in Tokyo and can join us with thoughts. So, Stephen, really interesting to hear the CEO of Shell there responding to increased risks and tensions, thinking about what the Iranian reaction function might be if we saw US involvement in this war. Talk us through your thinking around the Straits of Hormuz right now.
I think the market is looking at this as one of the high-risk areas. It is clearly something that if we do see any impact on the Strait of Hormuz, you're going to see a rocket up in prices. Some banks saying that Brent could go to over $130 a barrel from where we are right now in the $74, $75 range. Now, the Strait of Hormuz is not blocked at the moment. Flows are continuing, but that risk does remain. And while it does, still, it's a remote risk. There are fears that there could be delays or there could be impacts, or even if the situation were to spiral, Tehran could decide to start to strike ships going through the strait, which they've done in the past. Now, you have seen some precautions being taken. You know, we just had Shell here. He was speaking about how that company itself is also taking precautions. Meanwhile, you have Qatar, the world's second largest LNG exporter, telling ships coming there to load for LNG to wait outside the strait until a day before the actual loading to avoid any sort of risks there. And you have some Japanese ship companies also warning their vessels to watch the area, as well as avoid going too close to Iran.
Stephen, this is compounding shipping issues in the Middle East when it comes to the Red Sea already for likes of Maersk, Hapag-Lloyd, and of course the tankers there as well that are already using alternate routes. At what point do the alternate routes, which require more labor, more fuel, get overused or saturated? Is that a risk at all?
You know, it is something that the market has been looking at. And when the Red Sea shut, that was one of the issues as well. I mean, not shut, but when a lot of shipping companies decided not to go through the Red Sea anymore, it was an issue that we were worried about, that potentially you could see shipping rates kind of skyrocket. Now, that happened at an opportune time because there was also a lot of new tankers, a lot of new carriers coming into the fleet. So it didn't result in a jump in prices or a shortage in vessels. Now, of course, the Strait of Hormuz, while it is a key waterway for the shipping of oil and gas, the risk isn't so much shipping itself, it's actually getting the fuel to places. It's about a quarter of oil, seaborne oil shipments, 20% of LNG shipments. So while, and the thing is, there are no alternate routes there. I think one thing to look at is insurance rates. You know, around the Middle East, as you're having the Red Sea, as you have Strait of Hormuz, the whole region is becoming risky for shippers. So is this going to be an issue where insurance rates increase? Is this going to be an issue where ship owners say they don't want their vessels in that area? I think that's the real risk that threatens higher vessel rates and could increase transportation costs.
Yeah. Stephen, can I just go back to the Straits of Hormuz, because I think there's such a preoccupation for markets, and go a little deeper into what kind of disruption we might see there? Because we talk about this as if it's a sort of binary situation, either it's open or closed, but actually things might become much more complicated than that. You've mentioned how there have been attacks on ships in that strait in the past. There's previous there, and shutting it entirely might be very difficult given the presence of the US military, for example. So what specifically will you be watching for?
That's a really good point, because you wouldn't be able to just shut it. One, it might not be physically possible, is one thing that I think the market has been kind of digesting. It's large. So how would you shut it? Would you sink a ship there? You know, ships could probably still go around it. It's not like when you had the Suez Canal shut because a ship was stuck in the middle. This is a much larger waterway. At the other end, you have other countries on the other side. Iran's on one side, you have Oman on the other, and you also have the UAE. So, they have their own waters, and they're able to protect that as well. You mentioned the United States could come in. Now, how does this actually play out? I think the most likely scenario is probably if Tehran or Iran were to start attacking ships, you could see those vessels connected with the United States, Israel, and other countries in that alliance maybe avoiding the strait. You would still have maybe Qatar or other neighboring countries continue to send their vessels through, but maybe you'll have a situation where you don't have vessels that have connections or clear connections with the United States or Israel in the area at all. Another risk could potentially be that maybe not shutting totally, but there could be delays to loading of oil and gas itself.
Stephen Tepchinsky joining us this morning out of Tokyo, walking us through some of the risks around the shipping sector. We thank you so much, as we have one eye on the risk in the Middle East. We also have an eye on the luxury sector this morning, selling off in a very big way. A 220 billion euro slump in market value, heaping pressure on LVMH founder Bernard Arnault. A widespread luxury slowdown and succession concerns, adding to what one analyst is calling, quote, the biggest crisis in the firm's history. Our very own Angelina Raskoway wrote a big take on this. She joins the program now. Angelina, just walk us through very quickly the challenges at LVMH.
Hi there. Indeed, I mean, we know that the industry is under pressure, whether it's coming, where it's troubles coming from the U.S. with the threat of tariffs that are impacting consumer confidence, or also the downturn that we've seen in China. But there are internal issues at LVMH, and that's notably at two key assets. That's Dior and also Moet Hennessy. So both of them have been, culprits of hiking prices too much over the recent past. And now there's basically what we're noticing is that there's a consumer backlash. At Dior, which is led by Delphine Arnault, so that's Bernard Arnault's eldest child, there was also a supply chain scandal last year that generated a lot of bad press. So in the past, since LVMH shares reached a record in April 2 years ago, they've lost about half of their value, but that hasn't prevented Bernard Arnault and his family from buying the equivalent of more than €1 billion since the end of January worth of their stock.
OK, so a lot's changed in 2 years, Angelina. Talk to us about the conglomerate discount then that is applied to this business. Is that how the market is thinking about it?
Yes, indeed, Anna. I mean, LVMH is a conglomerate with 75 brands. And when you have a rising market, investors are more willing, perhaps, to ignore that conglomerate discount. But once it starts shaking, they pay more attention to it because, they're invested in very different industries. If you think about hospitality, they have hotel chains, but also they own restaurants. Of course, they own fashion and leather goods and wines and spirits. So all these are very different assets with different levels of margins. And what we found out during the reporting is that about 3 years ago, they explored the listing of Sephora in 2021 and listing it in Amsterdam. And about 2 years ago, Diageo, which has a stake in Moet Hennessy, they also asked to study the potential listing of Moet Hennessy, but that was dismissed by Bernard Arnault.
Angelina, thank you very much. Thanks for joining us, Angelina Raskoway, on the subject of luxury, and her big take story is available on the Bloomberg terminal and on the Bloomberg website, of course. Coming up on the programme, we'll get back to the central banking conversation. Some economists expect the SNB to lower interest rates to zero today. Many do. Most do, in fact. We'll get the details. This is Bloomberg.
And as expected, the Swiss National Bank cutting rates to zero by the tune of about 25 basis points. Immediately, you were already seeing a little bit of strength, actually, into the Swissy this morning against the dollar and against the euro as well. But remember, this was the consensus expectation from economists. We know the Swiss National Bank has really been dealing with a real severe decline when it comes to growth in Switzerland, also trying to navigate some of the currency story there, as well as geopolitical risk around the world starts to bolster flows into the Swissy. I want to bring in our very own Valerie Teitel to walk us through how we should be thinking about this, Val, in the lead up to this moment. There was maybe not a consensus thought, but a risk that we would go into negative territory at the SNB.
Yeah, they, I guess, declined to do that, failed to surprise, but we did return to zero rates. So we're still at the zero bound, which is, again, quite a surprise, being it was only just, 3 years ago that they did leave the zero bound and go into positive rates. But again, there was definitely arguments out there, Kriti, for them to cut by more than expected today. The basic one is, given the fact that the S&B only meets 4 times a year, if they want to keep pace with the ECB, it really warranted an extra cut today, and especially given that they want to tamper the Swissy strength. And if they want to keep doing that, one tool in their toolbox is to lower rates by more than the market expects. Given that the Swissy has strengthened by more than 11% versus the U.S. dollar, which is really posing risks of deflation in the country.
And Mark Cudmore earlier raising the question of whether this will even make a difference, whether what the SNB does can make a difference on that front, because a lot of the flows into the Swiss currency, of course, are around geopolitics and around risk haven. I'm drawn to a line that I know will be interesting to you, Valerie. The SNB says it's prepared to intervene in currency markets if needed. Now, that's interesting, isn't it? Because there's been some recategorization of the Swiss and what they're doing with currency by the U.S. administration.
Yeah, that's right. I don't think the Swiss want to stand out as being tagged anything further than a currency manipulator, but it was just in the last U.S. Treasury report that they were put on the watch list as being a currency manipulator. And look, if the Swiss National Bank is out there claiming they have many tools in the toolbox, rates is one, FX intervention is the other. But I see a quite big hesitancy for them to want to intervene in the FX market in a big way because there, frankly, will be blowback from the U.S. administration if they do that.
I think as we've been kind of digesting these numbers, you've seen a bigger move in the Swissy here. You can see it on the screen, a fairly now in positive territory. But Val, there's no more room to cut for the S&B. So if things do worsen here, I'm curious what we can learn from the S&B that applies to a Federal Reserve that's hesitant to get rid of that ammunition, a BOE, even a BOJ that's dealing with some of those risk haven moves.
Well, look, it was only a few months ago that the SNB did remind us that negative rates are in the toolbox. So in still some way, maybe they do have some ammunition, but they're maybe just less or more hesitant to use it, given negative rates do pose quite odd issues for the banking sector, for deposit rates, et cetera. But again, look, we're seeing the currency strengthen off the back of this. Is something they probably didn't want to see today, given how much the currency has strengthened. And again, you have to tie in the Middle East tensions all into this. Let's say that we do get an escalation in the Middle East and you get more safe haven flows into the Swiss franc. That's going to be a big problem for the Swiss economy, who's already projected to be in deflation later this year.
You mentioned the ripple effects from the S&B as well. We should also mention that this morning there were questions about the stability in terms of UBS and that they didn't actually pass the stress test that the S&B put. And a lot of that has to do with capital requirements as well. So in addition to dealing with the financial market repercussions, Anna, there's also this question of how the banking sector is going to be dealing with it. But the S&B is not the only bank in focus today, the BOE as well.
Absolutely. And Valerie Teitel will stay with us as we think about what happens at the Bank of England. We've heard from the Fed, we've heard from the BOJ, the SNB, the Bank of England on deck later today. Matthew Swannell joins us, Chief Economic Advisor at EY Item Club and former MPC Advisor to the Bank of England. So a great voice for us to speak to. Good morning to you.
Morning.
Matt, thank you so much for coming in. So do you see the decision as complicated and difficult at the Bank of England? I mean, today's expectation seems quite clear. We expect no change in policy, but the dynamics around the UK economy, are they getting increasingly challenging?
So I think you're right today, clear hold. The big difference comes August and into the latter half of this year. And I think if we look back to May, the MPC have been clear. They're looking at UK disinflation and trying to gain a little more confidence in their forecasts. Now, what do we need to see that come to pass? Well, inflation is on track. Wages are weakening. The labour market is weakening. That's all good news. But there's a lot of geopolitical uncertainty. We're still working out how firms are dealing with changing the national living wage, changing their employers' contributions, and that all feeds through to prices. So we're really seeing how this uncertainty pans out. And that's really what's going to drive how quickly rates can come down in the second half of this year.
Yeah, so you seem quite, you're not too worried about the inflation picture. And you and an earlier guest, I think, were also telling us that they think the second half of this year we will see the Bank of England moving to cut more in the second half, despite any inflation pressure. And Bloomberg Economics saying that any stickiness in inflation is not going to stop the Bank of England cutting rates. I mean, why are we also dismissive of what looks like a fairly persistent inflation picture in the UK?
Yeah, I think we can really point to three things. The first is that in the UK, rates are restrictive. So the Bank of England can go a lot further before it gets to neutral. The top of their range is 3.75, so they've got a couple of more cuts in the bag before they get to that level. The second is that the labour market is cooling. Now, we've seen a big drop in the May data, that's preliminary. But if we look below the surface, hiring is certainly slowing. And that's probably going to cause sort of an orderly loosening in the labour market. That'll feed through to price pressures eventually. And the third is that if we look at just what firms are saying they're paying their workers, those settlements are coming down. And that's a key indicator the Bank of England's pointed to as well.
Matt, how are the folks at the Bank of England thinking about the geopolitical risk in the world right now, specifically emanating out of the Middle East and having oil price ripple effects? Dan Hansen, our chief UK economist, put out some analysis this morning, saying that the $85 barrel threshold is where the BOE starts to get concerned about the ripple effect. Is that a fair price level to be looking at?
I think that's totally fair. The movements we've seen potentially so far, they're going to have relatively small impacts on inflation. And even going to 85, that might be something historically the Bank of England might have looked through. But we're in quite a unique phase at the moment. We've seen inflation expectations very high. People are hyper aware of the inflation environment. And the Bank of England are also quite worried about this becoming embedded. So if you put all those together, that really does mean that it's something the Bank of England has to think quite carefully about, and particularly given their concern about cutting too quickly rather than too slowly.
Yes, I feel like it's really interesting that have we almost forgotten the lessons of Russia's invasion of Ukraine? Oil prices went higher, and inflation in the very first months we talked about this being maybe transitory, but it was quite clear quite quickly that this wouldn't be transitory. It would have secondary effects on the rest of the economy. Companies had pricing power. Companies used that as an excuse, perhaps in some cases, to put up prices. That reaction function is still very recent. That could happen again, couldn't it?
Certainly, and I think I always point people back to the remarks from Claire Lombardoli at the end of last year. And she simply said that the cost of being too aggressive in rate cuts is much greater than the cost of going too slowly. And I don't think you have to be sort of a keen observer to see that that calculus is the same. We've seen inflation 3.5%, probably going to remain around that level for the rest of the year. Pay at 5%, that's clearly above the rate, consistent with inflation getting back to target, and services similarly close to 5%. So all that together, the direction is good. The level is still concerning for the Bank of England.
How do you think the Bank of England thinks about currency appreciation? The British pound has strengthened nearly 10% versus the US dollar. And we've just seen the SNB cut. A lot of that having to do with not wanting to have this strengthening currency move. How does the Bank of England think about that?
I think the Bank of England set out its framework quite clearly, and that is it's domestic inflationary pressures that matter at the moment. That means wages and services price and inflation. So currency movements are second order, and we have to sort of look back perhaps to like 2016 when we saw huge movements in the currency really affecting the Bank of England's reaction function.
Yeah, what do you think about the vote split today? Are we going to get a surprise three-way again?
I don't think so. I think we'll be looking for 225 basis point cut votes from the known doves, and I think perhaps the risk and the intention of a more dovish committee might appear if we see maybe Ramsden vote in that group as well.
Okay, so 7-2 is the consensus.
That's right.
Yeah.
Talk to us about the trade deal. The last time we heard from the Bank of England, a trade deal between the United States and the UK, there was a framework. We didn't have the details just yet. Is that something that's going to get addressed today?
So I don't think we're going to see anything in terms of what they think that trade deal means for the outlook. I think that will be saved to the August report. What I think we might see is an acknowledgement that progress is welcome, but there's still a huge amount of uncertainty around what that means for the UK economy. In terms of what that means for the Bank of England thinking, I think we have to remember that they were relatively optimistic in their May projections as to the negative effects of the sort of trade tensions. They only had a 0.3% hit to GDP. So progress has a relatively limited upside for them.
Yeah, and the negativity is that around reduced exports to the United States. I mean, we saw that in the most recent set of data on GDP, didn't we? It was visible there.
So of that 0.3, 0.2% comes from trade, and then there's a further 0.1 from uncertainty. So there is a trade effect that will have diminished slightly. Uncertainty that will still probably persist for a little bit longer.
Matthew, thank you very much. Matt Swannell, Chief Economic Advisor at EY Item Club and former MPC Advisor to the Bank of England. We thank you very much for joining us. It could be an interest. I mean, we don't get any change in forecast from the Bank of England today. So in that sense, maybe we moderate our expectations just a little, and no change expected, as we've seen from lots of central banks this week, Valerie. No change.
At least for the Fed, wanted to keep the market impact as minimal as possible, and they were successful in it last night. It was kind of a snoozer. So maybe we get that same from the Bank of England today.
OK, well, certainly we'll have here on Bloomberg TV all of the latest news lines coming through from the Bank of England later on today. Coming up, as President Trump refuses to say how the US will react, officials are fearful of a wider Middle East escalation. We'll discuss the economic implications of that next. This is Bloomberg.
You don't seriously think I'm going to answer that question? Will you strike the Iranian nuclear component? And what time exactly, sir? Sir, would you strike it? Would you please inform us so we can be there and watch? I mean, you don't know that I'm going to even do it. You don't know. I may do it. I may not do it. I mean, nobody knows what I'm going to do.
The level of trust between our countries is rather high. We have very good relations with Iran. We could continue this work and ensure their interests in this area. I will not go into details now, as there are many. All these details have been discussed with both the Israeli and American sides, and we have sent certain signals to our Iranian friends. Overall, it is possible to ensure Iran's interests in the field of peaceful nuclear energy. At the same time, it is possible to address Israel's concerns regarding its security. In my opinion, such options exist.
Russian President Vladimir Putin and U.S. President Donald Trump both commenting on the situation in the Middle East. So where do we go from here? We've got the perfect guests around the table this morning. Ziad Daoud visiting us from the Dubai office, the Chief Emerging Markets Economist for Bloomberg Economics. Ziad, just walk us through the possibilities here.
Well, geopolitical possibilities, there are three, right? So there's already a war between Iran and Israel. That is on the 7th day. What's the next step? It depends on the U.S. intervention. The U.S. could intervene. It's currently defending Israel. It could intervene by striking Iran, and that's probably the most likely scenario, given the developments over the last 2 days. The U.S. could sit things out and leave Iran and Israel engage in a prolonged war. That's the least likely scenario. And there is sort of a middle scenario in which the U.S. actually negotiates a ceasefire between the two countries. Unlikely, but it's possible. The most likely thing is that the U.S. will probably intervene by striking Iran.
That's your most likely. And how do you come to that conclusion? Do you attach percentages to those? Are there percentage chances of all of these three things coming to pass? Is it close? I suppose is my question.
It's getting less close over the last 2 days, given what we're hearing from the U.S., given also the fact that Israel is pushing for a U.S. intervention and is unlikely to accept a ceasefire, and given also, I think, the possibility that the U.S. would sit things out and let a prolonged war to continue is probably unlikely. And given that what we're hearing over the last 2 days, I think the scenario of the U.S. involvement is getting more and more likely, and that obviously has an impact for oil prices, has an impact for the global economy as well.
Okay, so let's think about that scenario. If the U.S. does get involved in direct conflict with Iran, where do you see the oil price going? Because in some way you can argue that maybe we won't see a big oil price rise because there hasn't been any impact on Iran's production of oil, and the U.S. has no interest in having an oil price shock, and they might perhaps deter, Israel or themselves from hitting any production. How do you view oil prices?
That's a big question, and I think the big lesson that we've learned, the Middle East has been in a state of war for the past 20 months, and I think the big lesson that we've learned from the past 20 months is that the geopolitics could escalate even beyond anything we've imagined, and yet oil prices could continue decoupling from that. So, if you think about the geopolitics, 2 years ago, every risk scenario that we could have thought of, even the remote ones, the tail ones, have happened. A war in Gaza that devastated Gaza, that has happened. An expansion of the war into neighboring countries, that happened in Lebanon. Regime change in the Middle East, that has happened in Syria. A direct war between Iran and Israel, it's entering its 7th day, and now we're talking about possible U.S. involvement in a war in the Middle East. And yet, if you look at oil prices today, even after the surge over the past week, they're still lower than the level on October 6, 2023. So the big question is whether this decoupling between geopolitics, which is heating up, and oil prices, which seem calm, will continue or not. And we can discuss basic scenarios.
Sorry, that's really interesting, the expectations around how oil prices will respond here. Because if I'm thinking about when Russia invaded Ukraine, and I know this is gas, not oil, but thinking about energy markets, it was quite clear quite quickly that this was going to have a long-term impact. Parts of the West were going to need to find new sources of energy. There's not quite the same conversation as happens when it comes to Iran. Of course, the Straits of Hormuz matter a lot in flows of oil and getting things out, and so that's why this sticks to oil prices. But the Iranian flow is not supposed to go to the West. A lot of it goes to China. So how does that influence your thinking, I suppose, on how oil prices are going to respond here?
You're absolutely right. So how geopolitics impacts oil prices is fundamentally how it impacts supply and how it impacts transportation routes. And over the past 20 months, the reason that there was a decoupling between geopolitics and oil is that neither supply, oil fields, nor transportation routes have been affected. So that same scenario could continue even with the U.S. involvement. It may not hit Iranian energy facilities. It could hit Iranian energy facilities and they can be affected, but that's only 3% of global supply. And prices would react, but probably going to be in the 70s, maybe low 80s. But there is a scenario in which you have disruption through the Strait of Hormuz, which supplies 20% of global oil supply. But even if that happens, it can happen and then that clears up very quickly, or it can happen and that disruption could continue. So even within that, we're talking about different possibilities.
Yeah, there's so many different ways of defining disruption out there when it comes to the Strait.
Well, disruption, but then also sustained disruption, right? So the sustained level of the oil prices. But my question to you, Ziad, is what is that level? We're at 77 at the moment today, 78 when the headlines first crossed and we had hit that peak. How high do oil prices need to stay for a more sustained impact on inflation, on growth, et cetera?
Okay, so let's talk numbers. So before the recent Iran-Israel war, what we had oil in the mid-60s. I think if you get a disruption to Iranian supply, which is 3% of the global supply, you could imagine oil being in the mid-70s. Now, if you have a disruption to the Strait of Hormuz, that's 1/5 of global supply, you can imagine oil going to $130 per barrel. But then there is the other question, which is how long can that last for? If there is a ceasefire negotiated after that, then oil prices could drop, which is what happened after, even with Russia-Ukraine, that lasted a few months, but then oil did come down. If that becomes sustained, then oil prices will remain high. The impact on the global economy, the general rule is, in aggregate, higher oil prices means slower growth, means higher inflation, and means higher interest rates. That's basically a simple rule. There's obviously a distributional impact. When oil prices go up, producers gains and consumers lose.
There's a question, though, that with these sustained oil prices, if you do see it at, you mentioned the 80s as a possibility, that actually incentivizes more shale production out of the United States and actually adds to the supply that OPEC is already pumping into the market. So in that train of thinking, or that line of thinking, is there a question here of just you oversupply this market so that the inflationary impact is subdued? Is that how we should be thinking about this?
I think there's two things here. And if you look at not just the past 20 months, but over the past 50 years, there has been a decoupling between geopolitics and oil. And there has been some form of, not decoupling, but a weakening of the relationship between oil and its economic impact. So if you think about the impact between, higher oil prices and the global economy, the sensitivity of the global economy to oil price shocks is probably lower now. Because you have alternative source of supply. You spoke about U.S. shale. We have alternative energy supplies, not just oil. There are other energy sources. We have, more spare capacity in terms of oil. And also, there is inflation. So a $100 oil price today is not a $100 oil price 10 or 20 years ago. That's
And a lot of the Middle Eastern economies that you follow closely, Ziad, they're very much focused, of course, on the geopolitical developments here and probably very worried about what's happening in their backyard. But you mentioned distribution effects. They could be some of the winners if they are oil producers, for example, Saudi Arabia with a higher oil price. Is that kind of thinking going to be cutting through in Saudi and other countries that produce energy products in the Middle East?
I think there's a couple of things here. I think the biggest worry is the geopolitical one. There is external threats on them from an Iran-Israel war that could spill over to their territory. And there is a domestic threat from their population. People are not happy with this war, and that could be, that could have ramifications. But in terms of the economy, generally high oil prices is good for most Middle Eastern countries. But if the spike in oil prices, the one that goes to 130 because the Strait of Hormuz is shut, they won't benefit from it because it's oil prices spiking because the world is losing their supply. So countries like Russia might benefit from it, but maybe not the Middle East. So it depends on what type of shock and what kind of disruption we get to the oil market.
Yeah, absolutely. Zayed, thank you very much for joining us. Ziad Daoud from Bloomberg Economics with us this morning to think about the impact on emerging markets and the region economically from disruption in the Strait of Hormuz, if that comes to pass. Let's focus in on some of the other central banking activity that's taking place today. We've talked about the Bank of England. That decision due at 12 noon UK time. 9 a.m., that's in, 6.5 minutes. We get the Norges bank rate decision, so we'll have coverage of that. US markets are closed, of course. It is Juneteenth, so no cash trading on stocks or on treasuries. And EU finance ministers will be meeting later on today. And no doubt some of the things we were just discussing with Ziad will be on their agenda, thinking about the way that oil prices higher impact on these markets. Now, geopolitics and its impact on central banking, really clear to see. We started this half hour talking about the SNB and the way that they are cutting interest rates, but they're fighting against big geopolitical forces, aren't they, Valerie? They're cutting interest rates, but it wasn't really interest rates that was driving money into the Swiss franc. It was that haven status.
Yeah, they don't necessarily welcome this haven flow, especially after currency has already appreciated so much on the back of this phenomenal dollar weakness to start the year. But look, dollar Swiss at the moment trading roughly flat. So the markets kind of absorbed the fact that they didn't go for that jumbo 50 basis point cut, nor did they really signal in their commentary that they intend to cut in September. That might have been something that could have helped the Swissy weaken today, but we didn't get that kind of commentary coming out of the SNB.
It's fascinating as well. We're talking about this currency impact, the currency manipulation label coming from Washington as well. We are also waiting for what they have to say on pharmaceutical sectors and tariffs as well on that sector. And that's something that's going to affect the Swiss economy in a very big way that you can't really model out at all.
And that's another reason why perhaps the SNB is hesitant to do any direct FX intervention while these negotiations are ongoing. They do want to stay on a stable footing in terms of their relationship with the Trump administration. You know, we kind of saw that happen to some of these Asian economies, like the Taiwanese, for example, kind of unwilling to intervene when their currency strengthened because they didn't want to get on a sour footing with Donald Trump.
Right, and thinking of Donald Trump and his policies, that takes us back to trade. And while we've been thinking about geopolitical risk, the ECB is talking about the other big risk out there, and that is around global trade. The ECB's Christine Lagarde saying that greater regional trade can offset global losses, which I think is an interesting line to be taking. So not using the US example as a sort of test case or as a blueprint for what other regions are going to do, but suggesting that Europe can still be at the forefront of global trade and pushing that global trade narrative. But just some of the comments that we're getting through from the ECB.
Yeah, we also did hear from Olli Rehn speaking about the Middle East conflict, actually saying that the Eurozone risks stagflation shock, if this Mideast crisis extends. So stagflation on the mind of not just the Fed, but also the ECB amidst this Middle East crisis.
It'll be interesting to see what the BOE has to say on that later. And before, of course, we hear from the BOE, we're going to hear from the Norges Bank as well. Also an oil-exposed economy, also needing to be thinking about maybe the positive for the Norwegians, but something that factors into their decision-making.
Yeah, certainly something that will come up in the conversation, no doubt, as it will when it comes to the Bank of England. We don't get a change in forecasts, but no doubt a lot of the conversation will be looking for any kind of guidance around the second half of this year. How are they thinking about geopolitical risks and what that could do to the UK economy? That is it for the opening trade. The Pulse is up next. We don't have US trading today, as we've said a few times, but we do have European trading, and we'll be here to take you through all of that. European equity markets are weaker this morning. This is Bloomberg.